Well, good morning. Thank you so much for having us. As Roseanne mentioned, my name is Rebekah Martin, and I'm an audit partner with Baker Tilly, and I focus in the not-for-profit higher education space. And with all of our not-for-profit audits, and all audits across the firm, we have to consider fraud. And so we do a lot of training internally regarding fraud and fraud risks within the firm as part of our continuing education fraud professionals. And we're kind of excited to share with you this morning a little bit about fraud risks, and maybe how to mitigate some of those risks. You wanna do a brief introduction?
Yeah, good morning, everyone. I'm Carla Hirsch. I'm a manager in the risk advisory practice at Baker Tilly, and I focus on co-sourced and outsourced internal audit engagements, Sarbanes-Oxley compliance, enterprise risk management, and really work with clients to identify controls to mitigate fraud risk. And then also working with clients to identify ways to prevent fraud at the prevent fraud from happening.
Great. So we're going to get started by just kind of giving a little bit of an overview of fraud, kind of identify some of the risks. And then Carla's going to wrap us up talking a little bit about prevention of fraud and really mitigating those risks. So just to kind of make sure we're kind of all starting on, the same foundation, fraud really includes those intentional acts or deliberate acts to commit fraud. And those can happen, externally or internally within organizations. When they've gone back and looked at kind of all of the fraud risks, I'm sorry, I don't know.
Yeah, sorry, we might switch out mics here.
There we go. Okay, I'll just talk loud. Is that okay? Yeah. Okay.
It's actually about the same.
Good. As they went back and looked at, historical fraud cases, they really put together kind of a methodology of three things really aligning in all fraud cases. Really that being rationalization, individuals really rationalizing within themselves as to why, committing the fraud is okay, and how they really kind of overcome some of that internally. There's an opportunity of fraud, whether that's a lack of internal controls, a lack of segregation of duties within the organization, a lack of oversight, and then some sort of pressure. They often saw in looking at different fraud cases that there was a financial hardship, whether it was a sick family member, an unmet need, whether it was a gambling issue or a gambling problem. There was some sort of pressure on the individuals to really create the perfect kind of form for fraud. To the next slide. One of the case studies that we wanted to share with you that really kind of shows how these three things align in specific fraud cases was in 2014. It was revealed that there were more significant wait times in VA hospitals, and they were much larger than what their target was. And employees were compensated based on these metrics of wait times within the VA hospitals. The Phoenix VA specifically was caught having a secret wait list that was kind of off the books, off the system, and that information was not made public because it would really mess with the bonus structure. And so employees were incentivized to keep this kind of on the side. Employee wait times, their target was really kind of a 14-day wait time, but the wait times were much more significant than that, kind of in that off the books wait list. So subsequent audits of the VA showed that there were pervasive incentives across the organization to create this opportunity for fraud. So not only did the employees have the opportunity to kind of keep this off the side list, there was also pressure in the way of incentives or bonuses that were based on this specific metric. And employees were able to rationalize it within themselves to keep this type of thing. I also think, one of the most recent cases that just kind of comes to mind is also when we look at, the incentives with Wells Fargo and it, incentivizing employees to create multiple accounts for their customers. And so we also saw, some of that in our recent history as a similar type of case. So we have a couple of polling questions in here, and I know there's polling questions online. But what may have been the employee's rationalization to falsify the records? We have the 14-day target, there's no review of the records, but they wanted to receive their bonuses. So really all of the above, right? So there was a lot of different pressure that was on these employees to create an opportunity for fraud. So as I mentioned, we typically see fraud in kind of three buckets, that being external fraud committed to organizations. This could be theft or counterfeit. This could also be cyber crimes. We're seeing a lot more with our clients in that area, specifically as it relates to ransomware or phishing type schemes. One of the most recent conversations I've had with some of our clients from external parties is related to unemployment fraud. So we know that there were incentives as it relates to kind of our government's response to COVID with additional funds for unemployment. And what employers saw that was either employees filing for unemployment claims that they shouldn't have, or third parties filing for unemployment claims using stolen information for their employees, which has caused a lot of issues because, as you can imagine, a lot of those funds were paid, and then there's a look back to see if they were legitimate claims. Internal or occupational fraud. This could be corruption, misappropriation of assets, or misreporting financial statement information. I think one of the examples that maybe comes to mind here is, a couple of years ago, we heard about a case in Dixon, Illinois, where the comptroller treasurer was able to steal $53 million over a 12-year period by basically having control of the books and being able to siphon off cash to a separate bank account. And really that was, perpetrated completely internally within the organization. And then the last, kind of bucket of fraud that we see is typically against individuals. So we know that there are the Ponzi schemes out there with the Madoffs and the Petters that have been out there, as well as various phishing schemes where we see texts now and emails coming through that ask you to click on a link, input your bank information or your login information. And that's where we see, a continued increase in creative ways to perpetrate fraud against individuals. Some of the common fraud scenarios within organizations are listed here on the slide. We kind of put them in four kind of buckets of areas where we typically see fraud or maybe heightened risks of fraud. The first is really payroll. So looking at setting up fraudulent employees, increasing pay rates without proper approval, or potentially overcompensating. Sometimes we'll see inflation of hours if there's kind of a self-reporting for hourly employees on time cards. We've also seen organizations that have maybe terminated an employee and that individual having access didn't actually terminate them in the system, but just changed the address. So the checks were actually going to the payroll person instead. So these are all things, kind of around payroll as we look at money going out of the organization where there could be, potential risks. Kind of in a similar situation on the cash disbursements or additional checks or ACHs going out of the organization, fake vendors being set up within the system, a related party or overpayments to related party organizations as well. I had one client talk to me about their brother-in-law worked for an organization that would order supplies. So they'd order brooms and they'd order mops and things like that to keep the manufacturing organization clean. And what they found in going back through the records was that the janitor actually was buying supplies from his brother-in-law. He was buying 10,000 brooms at a time. And so they went and tried to look for these 10,000 brooms and there were none. So things like that, where there's an opportunity to either override controls as it relates to purchasing or circumvent the controls. Financial reporting, very similar to kind of the VA situation where there was non-financial metrics that were used to measure bonuses. Many organizations provide bonuses based on outcomes. So how much revenue are you bringing in? What are your sales outcomes? What's the operating net loss or net surplus for the year? And often employees are compensated based on those metrics. So there's additional pressure to meet budgets or perform at a certain level to create those maximum bonus potentials. And then lastly, we look at corruption. We look at conflicts of interest. So, having relationships with organizations that maybe board members own or have significant interest in, or owners or subsidiaries of organizations, and then accepting gifts from donors. So in the not-for-profit world, this is definitely something that we pay a lot of attention to, is really the relationships with not only the board, but also donor relationships, to make sure that everything is on the up and up, that everything is communicated and is very transparent as it relates to money coming into the organization. And I think, I just saw on Netflix, there's a new documentary about the Varsity Blues. Maybe it's not new, I just haven't seen it before. The Varsity Blues scandal, where we had parents basically paying a foundation for entrance into college for their students. And when I think about corruption, I think that's one example in our recent history that kind of comes to mind as it relates to conflicts of interest and relationships with donors. So here's kind of a graph of some of the common fraud types, and this really comes from the Association of Certified Fraud Examiners and their most recent report. We see, again, a lot in the kind of cash disbursements, so money going out of the organization, whether it be billing or payroll or skimming off of skimming cash, and then corruption, kind of being the second leading fraud within organizations. Some of the impacts, we think a lot about risk as it relates to our organizations, and some of that in the way of reputational risk. Now that we have our cameras on our phones and we've got the Twitter and I don't know, TikTok and Facebook and all of these social media where we can kind of post what we're thinking on the spot, reputation becomes even more important than ever. And the risk of fraud to a reputation can really impact public confidence in your organization, existing relationships, and potentially future relationships. They say approximately half of all fraud victims don't recover what they've lost. So you think about the Dixon, Illinois case, where she stole almost $54 million. There's no way to recoup the money for that city. Their firefighters and policemen had gone years and years without any type of pay increases and benefits. And all they have really is trying to sell off her assets to try to compensate the city. Typically these frauds start small. They may be a $20 gas charge on a company card, or taking a spouse out to dinner, things like that. And then as individuals become more and more confident in their schemes, we see the dollar amounts continuing to increase exponentially. According to the Association of Certified Fraud Examiners, the typical loss to an organization is about 5% of annual revenue. So that can add up very quickly when we look at fraud cases. And these are all based on kind of historical look back on what we know to be fraud cases. Fraud creates a distraction from the core mission and the core values of an organization, and can also cause employees to become uncomfortable or uncertain about what their future might look like. So there's morale issues that can come as it relates to fraud. And the last thing that I'll kind of mention on this slide is that we have a whole team at Baker Tilly that works on kind of fraud investigations, and they're expensive. When you are kind of looking back, trying to go through years of records, trying to filter out what could or was flawed, and maybe where that all penetrated within the organization, can be very costly to go back and try to quantify and look at the impact of that. Terminating employees also, there's definitely a risk there as it relates to having all of your documentation and things in line as well. So some of the red flags, like which we think about in our businesses, where should we consider specific fraud risks? And I know Carla's going to go into that a little bit more as to maybe specific areas that we can look. But areas where employees have absolute control. One thing we may not think about is employees that don't take PTO because they can't be away from their job because the organization needs me. And without me, things can't keep going. We all know that, but that's not true for the most part. And so, some of the phrases that we've included here, again, come from the Association of Certified Fraud Examiners, but this is the way it's supposed to work, or, oh, we can circumvent, or we can work around that this time. We can make a one-time exception. It's only one time. Some of the things we can look at from maybe a higher level perspective is unexplained variances in budgets. Doing, some sort of, kind of spontaneous look at, oh, how many brooms do we have in the closet? Do we really need to be ordering more? Those type of things, I think are definitely value added. Where we typically see kind of that opportunity is where we have a lack of expertise, where we have a lack of oversight and a lack of segregation of duties. And we talk to our clients a lot about segregation of duties, and some of them are like, yes, but we know our employees would never do that. Well, trust can, while we want to have trust within our organizations, we also want safeguards, not only for our organizations, but also for our employees. So I always try to spin it when we're talking to organizations and say, yes, but if you have this safeguard in place, you're also protecting your employee in case there's a questionable act or something that comes up that's unusual. You say, well, yeah, but we've got these checks in place in order to protect our employees from any type of suspicion or any type of mistake happening within the organization. I think back about that Dixon, Illinois case, and the way that they found the fraud is that she went on vacation and bank statements were coming in that the individual that was receiving the mail had never seen before. So they started investigating and found that it was bank accounts that were set up to have a similar name to the city, but that were in her name. So she was just transferring money out to another bank. And that's how they found it, was that she took a vacation and didn't have that absolute control any longer over that process. So I think Carla's going to walk us through some of the mitigation activities within the organization. We talked a lot about internal controls, conducting kind of a fraud risk assessment, leveraging data within your organizations to create data analytics, and then internal audit, which is definitely a specialty of Carla's. Yeah. So starting on kind of the internal control side, I definitely think that there are, kind of controls put into two buckets. You've got your preventative controls and your detective controls. And the preventative controls are really your policies, your procedures, training within the organization, communication to your employees or expectations, as well as segregation of duties. Listed on the slide are a couple areas where we typically see preventative controls. Often organizations will have requirements for multiple signatures on checks over specific dollar amounts. Also physical access controls. One of the things that we've been talking to our clients about as we move to a remote work environment is now what are your access controls around their technology? Your laptops and your iPads and your phones that may all have access to information within your organization that may 2 years ago have resided in paper files within your business. So that's definitely something to think about. Also, having a whistleblower hotline or doing rotating type audits can definitely be preventative measures to deter your employees from perpetrating fraud. And then on the other side, there's the detective controls, so kind of back-end controls that may be able to identify unusual activity through various processes. And this may be management review, this may be a budget to actual, this may be, again, spot checks and an audit trail of various transactions. The second kind of preventative measure is looking at a fraud risk assessment. How many of you have done a fraud risk assessment within your organizations? That's great. We definitely find most organizations are probably on the forefront or kind of the beginning steps of really looking at what a fraud assessment would be. But it really creates an opportunity for all of those in the organizations to give their input as to where the risks would be. Those in the organizations have the best sight and the best perspective to help identify where those risks are. We have a lot of tools at Baker Tilly where we work with clients to kind of create a risk map and maybe rank those risks based on likelihood of fraud happening within a specific area, as well as the impact. We know that some fraud, may have a pretty small impact. Other frauds that have a very significant impact, maybe not only with financially or monetarily, but also with your reputation and risk within the organization itself. Really having that map and being able to rank those risks helps organizations really focus on where they can get the most impact for their preventative measures. And as organizations mature, those risks may change and you may need to elevate specific risks. I think 2 years ago, all of us probably had pandemic on the very bottom of our risk, map, right? As overall, not necessarily as it relates to fraud, or we're working remotely. And I know, those risks have all changed. So, keeping the assessment really a live, active document and really looking at, as the organization changes, how are our fraud risks changing as well? We've also seen a lot of organizations that have had people in their positions for a long period of time. And in the last 2 years, we've seen a complete shift of early retirements, individuals stepping out of the workforce, or maybe stepping back in their positions. And I think that that's created an opportunity to maybe look at things differently and create additional internal controls within those specific structures, or structure those positions a little bit differently to enhance the internal controls, whether it's preventative or detective as well.
I can take it over from here. So as Becca mentioned, we see a lot of organizations complete different types of risk assessments, whether it be an enterprise risk assessment, a fraud risk assessment, a cybersecurity, operational, IT. And really, it's important to make sure that these risk assessments also consider the risk of fraud. Sometimes we see that last piece, fraud, not included in these assessments, and it's really important, as including and identifying fraud risk can help improve communications throughout the organization and really break down any potential silos that might take place between the different teams. It helps identify the most vulnerable activities to fraud. And it really forces the team to develop plans to mitigate fraud risk across the organization. It also helps the team understand if fraud has occurred and obviously take action to identify how it occurred and how it can be mitigated in the future. And it really helps the team assess the internal controls that are in place and identify where those fraud risks may be and maybe where there's gaps in internal controls. It helps the organization identify regulations and professional standards that they have to comply with, and also understand the potential for significant risk of fraud. So in assessing the risk of fraud, the purpose of the risk assessment is really to proactively identify and understand potential fraud risks and schemes impacting the organization. So we've outlined 4 key steps that we typically work with organizations to complete in order to assess the risk of fraud. So the first one is to identify, second one is to measure, third is to rank, and fourth is to develop an audit response. So Becca talked about this briefly, but the first activity is identify the risks and the potential fraud schemes that could occur. So we typically have the organizations hold meetings with key stakeholders, and this includes accounting, finance, IT, purchasing, payroll, legal. It's really the whole bandwidth of the different teams across your organization who work with vendors and customers, really on that ground level to make sure that everyone is included in this assessment, because really the people who are recording the transactions in the accounting system, working with the customers, have more of that opportunity to commit fraud. The second activity is to measure the fraud risk. So as Becca mentioned, this is ranking it in terms of impact and likelihood. impact to the organization if the fraud risk could materialize, and then the likelihood that it would actually happen. The third step is to rank these risks and from high to low. And we typically see this done in some form of heat map or risk listing where you can really identify where are my key risks. In the top right quadrant here is the high, and then maybe the ones that are lower, the bottom left here, we can monitor, but we don't necessarily need to take action right away. And then the fourth step is to develop an audit response. So identifying what the mitigation plans are to address the risk, implementing controls, then having a function, whether it be internal audit or some other team, test the controls or conduct specific procedures to ensure that the controls are operating effectively. So as I mentioned, the first step is to identify fraud, and this can be difficult. You kind of have to put that fraud mind into, think about where our employees could commit fraud. So we've listed a few scenarios on the slide here. So for fictitious personnel expenses, corporate cards are intentionally issued inappropriately, resulting in fraudulent expenses. Expenses submitted for services or goods are not actually provided to the organization. So like Rebekah mentioned, that broom situation where no one was actually getting those brooms. Multiple expense reimbursements are submitted for the same expense. For fraudulent disbursements, it's fictitious vendors are set up in the system, resulting in fraudulent payments. And I actually recently had a client where a fictitious vendor was set up from some phishing scenario. The fictitious vendor got into the system, filled out the new vendor form, faked the approvals. So the disbursement went in, it looked like it was a real vendor, the payment went out. Obviously it was, I think it was caught by the bank, but really people are getting very, very nifty when it comes to phishing schemes and fraud schemes. I mean, they went into the email and found the actual new vendor form and filled that out, which is, no one was expecting that. Then for concealed liabilities and expenses, bad debt expense is intentionally omitted. Expenses are capitalized versus being expense upon occurrence. Related party transactions, so one party receives some benefit not obtainable in an arm's length transaction, and then embezzlement, personnel pay expenses with the organization's funds and falsify the financial records. These are just a few scenarios that we came up with. So the next slide includes some opportunities and common pitfalls we see when conducting a risk assessment. And I think I mentioned a few of these already, but making sure the right stakeholders are involved in those conversations. So having the people who deal with customers and are in the sales team, the people who are interacting with vendors and handling those transactions, making sure they are part of those conversations. And then another pitfall is ignoring that could never happen. So Rebekah mentioned a lot of the fraud schemes that we see are actually pretty simple. And so you might not think, oh, no one would ever do that. It's too simple. It will be caught by someone within the organization. But that's not always the case. And so, for example, if a CFO is paying themselves with company checks, you would think that could never happen, but we've seen it happen before. And then another one is utilize a risk-based approach. So within that heat map that you have in your assessment, taking a look at those high risk areas and making sure those are monitored and there's mitigation plans in place and those controls are being tested periodically throughout the year, and then focusing maybe on those lower risk areas after the high risks are monitored and considered. So question 2, and again, we thought we needed bullet questions, but who plays the Bernie Madoff in the 2017 HBO movie, The Wizard of Lies? Anyone, any takers? I didn't know myself, I had to look it up. So it's C, Robert De Niro. Okay, so the third method to identify and mitigate fraud is by using data analytics. So organizations should review data to identify trends, patterns, and anomalies in their data set to identify fraud. So organizations should look at data sets and transactions history related to operational and financial areas such as the general ledger and those journal entries, accounts payable and accounts receivable, inventory, IT, timekeeping, payroll, Pretty much any function within the organization should be examined for the risk of fraud. And then on the next few slides, we'll talk about specifically what teams can look for within the AP, AR, and travel and expense areas when examining these data sets. So for accounts payable, we typically look for duplicate payments, and this is payments made to the same vendor on the same date for the same amount. Split invoices, so people could split an invoice to avoid invoice approval thresholds. So for example, if all invoices over 5,000 are routed for approval, they would split it so that it would be under that threshold so that it would be automatically paid. Third one, payment date before invoice date. Payments on non-business days or during non-business hours. This may not be as relevant in the post-COVID environment as people are paying during non-business hours all the time now, but round dollar or negative invoice amounts, payments to inactive or non-existent vendors. So taking that disbursement list and comparing it to the vendor master file to make sure that that vendor is active and that the disbursement went out to the right banking information or to the right address. Taking a look at the average number of days between invoice date and payment date to make sure that is reasonable and there's no outliers within the data set. And then looking at top vendors by spend or number of payments to make sure that's reasonable and what you would expect. Invoices without valid POs or vouchers, missing or out of sequence check numbers, and then payments that exceed the invoice PO or voucher amounts. Then from an accounts receivable perspective, we typically look at age receivables by customer to look for any anomalies there or customers that stand out. The number of days between cost incurred and payment received, duplicate customer accounts, customers with no address or phone number or contact information. We recalculate sales and profit margins to see if there's any trends there or any outliers in the data. We verify accounts with credit balances and accounts with total amounts or individual balances greater than the credit limit to make sure that those orders were approved. And then lastly, from a travel expense perspective, duplicate expense reimbursements or split expense reimbursements to make it appear that maybe they didn't actually spend the amount that they spent. Expense reimbursements after employee termination. And so this would be comparing the reimbursement listing to the employee listing to make sure that all employees are actual employees and they're active in the system. Expense reimbursements to ghost employees, top employees by spend and or number of expense reimbursements. So making sure that the people who you would expect to be requesting reimbursements are those top people in that list. And then the expense reimbursements for unallowable vendor or good or service or amount. So these are typically performed by keyword searches based on your travel and expense policy. So the fourth mitigation strategy we have here is internal audit. The role of internal audit in fraud risk management can vary by organization. And responsibility is often shared between the board of directors, management, the audit committee, legal and compliance, and then also internal and external audit. So it's important to define and communicate roles and responsibilities when it comes to fraud risk management. And we typically work with our organizations to make sure that they have a response plan in place, that there's a person who fraud is reported to, whether it be a whistleblower hotline, or they have direct access to an audit committee member, or the compliance officer, risk management officer, and making sure that there's a responsible party for carrying out the investigations, whether it be a third party or an internal party. To carry these out, it's important to make sure that they have the appropriate skill sets to do so. And then making sure that there's a function similar to internal audit to identify the fraud risk controls and also test them periodically throughout the year. So we have the 3 lines model here, and this was recently updated in 2020 to really focus on the active forms of risk management. And so the first line is really the people responsible for risk and fraud management. So this is going to be the business and process owners. And they're really responsible, like I said, for making sure the controls are in place and that they're operating effectively. The second line oversees risk management and ensures that the first line has all the information, the tools and the templates and resources they need to be successful in mitigating fraud. And the third line is that independent assurance, typically the internal audit function, and they're responsible for verifying the operating effectiveness of lines 1 and 2 and those internal controls. We wanted to note that internal audit, or that third line, is not necessarily responsible or should be held accountable to fraud risk management. It's really those lines 1 and 2 who are responsible and accountable for fraud risk management, and internal audit provides advice on how to further mitigate the controls and strengthen the control framework and also test those controls. So this slide here shows the internal audit professional practices framework is really the starting point for internal audit guidance, and provides fraud and internal audit standards for detecting, preventing, and monitoring fraud risk. So the last piece of our presentation here is a case study, and it involves Cost Corporation and Sue, who used to be the VP of Finance. So Sue worked at Cost Corporation, which is a family-owned company in Wisconsin, as the VP of Finance since 1992, and she stole over $30 million in 7 years. So as Becca said, it often starts small, and I don't know if this is necessarily small, but over 7 years, started at 2 million per year and then worked her way up to 10 million in 2010. So the control in place was that the CEO was to approve invoices over $5,000, except for large wires and cashier's checks were excluded from the control. So Sue authorized wire transfers to American Express and cashier's checks to pay off her personal cards, which were also at American Express. Fraud was uncovered when the bank brought up the wires to management. The accounting system was about 30 years old, which lacked an audit trail and allowed open access to prior periods, which cannot be locked or permanently closed. So obviously we can see there was a lot of opportunity for Sue to commit fraud within the organization. And our last polling question is, what was Sue's opportunity or ability to carry out the misappropriation of funds? And I think we can see it's all the above. The control was not designed appropriately, and so there was really a gap there where the wires and cashier's checks weren't receiving a secondary review. There was an outdated accounting system, so she could go into the accounting system, falsify the records, change them without anyone knowing. And then thirdly, there was lack of segregation of duties, so there wasn't a secondary review over those disbursements leaving the organization. So some key takeaways we have, everyone is susceptible to fraud risk, and fraud stems from those 3 driving factors of opportunity, pressure, and rationalization. Fraud can be deterred with consistent training and proper internal controls in place, and then preventing fraud can uphold a company's reputation and make a firm more financially successful. I think we have some time for Q&A if there are any questions. Yeah.
You see in your reviews that the board of directors, shareholders, or owners are really the responsible party for incentivizing fraud or creating a culture of fraud that permeates through the organization and creates the foundation for individuals to conduct their own fraud, including the cost base.
Yeah, I think that that's a really good question because, definitely the pressure typically comes top down, right? Whether it's building incentives to compensation, building in specific matrix, whether it be financial or if we talked about in the VA case, kind of non-financial matrix. But typically that's a top down. And, we see that the board of directors and stakeholders obviously have kind of their own interests at play in many cases, for a profit company. But management really sets the tone as to how that's acceptable, and also looking at internal controls in place to prevent, right? And so I think, Carla, that kind of goes back to some of the thoughts that you had. I thought one of the other things that was really interesting in some of the research around the Association of Certified Fraud Examiners is that most fraud is caught internal, through whistleblower, through employee. And when we go in to do an external audit, which is the least likely to find fraud, it's not designed to find fraud. We ask those questions. Has your boss ever asked you to do something you're uncomfortable with? If so, what would you do? do you feel like you have a clear line of communication to someone other than your boss? Because it's typically, kind of that top-down approach where there's an environment or a culture that says, this is what we need to do, and these are the okay steps to get there. Whether it's circumventing controls or going around things. So they looked back at the Enron scandal a number of years ago, and some of the study that came out of that is employees said, if someone would have come in and asked me, if my boss asked me to do things I was uncomfortable with, I would have told him yes, but no one ever asked me. And so having that open culture of communication or clear lines to communicate even in an anonymous way through a whistleblower policy, I think is extremely key to being able to identify where there's going to be risks from that kind of top-down culture.
Yes, definitely enjoyed your conversation and comments, etc. My question is, I was at one point in time the treasurer of an organization where the controls over check distribution were eliminated basically to make things more efficient. So basically, as treasurer, I had the opportunity, absolutely no system controls over distribution of a check. So I certainly know how I approach that, but would like to know your thoughts with respect to how you would recommend approaching that situation.
Yeah, as a treasurer of the Carver's Cat Humane Society, which if you're looking for a dog or cat, that's kind of, one of the first things I did was make sure that the organization had a bonding policy, right? Sure, just in case. But also really pushing the organization to provide those internal controls. Because like I mentioned, internal controls protect organizations, but they also protect employees. And I think it's really important to emphasize that, because as you can imagine, working in nonprofit, everyone says, well, no one would ever do that. Everyone's here for the mission. Like, we are all really committed to the mission. No one would ever do that. But what internal controls do is they protect from any type of suspicion. Anyone coming in from outside that says, we want to look at this because this doesn't look right. And what are those internal controls? And so it's very difficult in small organizations to make sure you have that kind of segregation of duties or that check. But I would definitely really push the organization, challenge them, and just say, I'm uncomfortable with the structure. We need to find some sort of additional internal controls, whether it's a second signature on the checks, whether it's setting them up in a QuickBooks system, so there's an audit trail of kind of what those checks look like, and having kind of that secondary review.
I have a question from the audience, the virtual audience. Do you find background checks on accounting personnel mitigation risks? Do you require all clients, financial leaders to have them?
We typically do see background checks completed, and that's something that we test for public companies to make sure that background checks are being completed for accounting and now including IT, because IT has so much access to the accounting systems, and then also the finance leadership as well, are the three groups that we typically look at if it's not being performed throughout the organization for everyone.
I think one thing to note is I think background checks are a great standard for kind of your HR hiring process, but not all organizations prosecute or pursue people that commit fraud because of the cost. The cost is a barrier and really inhibits especially smaller organizations from really pursuing anything, especially if they've deemed the amount, not material, and that's different for every organization. If I'm a $2 million, budget, $2 million a year in expenses, $1,000 may be a bigger deal than if I was, a $20 million organization. And so I think background checks are great, but they're not necessarily a safety net to prevent all individuals with, bad intentions from committing fraud. Questions?
With respect to conflict of interest policies, I've certainly worked for organizations where there were required for board of directors, for management, and in some organizations, conflict of interest policies throughout the organization. So could you talk a little bit about how prevalent are conflict of interest policies within corporations and within nonprofits.
Yep, go ahead. Okay. I mean, we definitely recommend as part of good governance of any organization to have conflict of interest policy in place and to have individuals sign or represent to no conflicts of interest, at least annually in writing. And then also at meetings, you know, on the not-for-profit side, we definitely recommend that there's a standard agenda item that we review the agenda and make sure that we identify any types of conflicts of interest where someone may need to step out of a voting situation. So that could be, you know, we're looking at a banking relationship. Well, you know, Tom sitting on our board, he's the CFO of the bank, one of the banks we're looking at. So he should probably step out of voting on making a decision. And again, I think that it protects not only the organization, but also individuals from there being any type of, you know, perception that there may not have been an arm's length transaction. But I think, you know, conflict of interest policies are only, and conflict of interest statements are only as good as someone reviewing them and also looking at the activity of the organization, right? And kind of monitoring that. So, you know, I think it's great to have in place, but I think you have to have an active policy and an active procedure in place to really make it effective.
We suggest that organizations complete at least a quarterly analysis, looking at those potential conflict of interest transactions, looking at, you know, the disbursements, the lease contracts, anything that could involve a conflict of interest, and taking a look at those at least quarterly and making sure that they were discussed with management and the board if necessary.
And for not-for-profits, they're all disclosed on the financial statements. And the 990, which is a public document. So I think also just being aware of public perception of what those relationships are, I think is important.
Any more questions? All right, well, thank you guys. We appreciate it.
Yeah,
Thank you.
for having us.
Yeah, thank you, Baker Tilly. They did leave some goodies out on the table, so if you want to grab something on the way out, please feel free to do so. Thank you, everybody, for coming.
Thank you.
Nice. Thank you. That was good. Thank you for having us. I always think fraud is such an interesting topic.
Well, it's interesting. I lived in Ely, and the woman that was the assistant clerk took petty cash. Because a lot of people in a small town pay in
Big cash, yep.
She's been doing it for years. And a new city clerk came in and started to kind of be suspicious of it. The only way they caught her.
Yes, thank you very much.